Only 16% of Americans say they are very likely or likely to buy an electric vehicle as their next car. Meanwhile, the percentage of those who are unlikely or very unlikely to buy an EV has surged to 63%, marking the highest level since 2022. The electric vehicle sector is entering its biggest crisis yet, with a massive wave of brands announcing delays or outright cancellations of their upcoming models. Prominent names like Volvo and Lamborghini have pushed back or completely walked away from their 2030 all-electric goals. Meanwhile, Ford's dedicated EV division Model E booked a staggering loss of approximately $5.08 billion in 2024 and projected further losses between $5 billion and $5.5 billion for 2025. This raises critical questions. Which automakers are ditching EVs next? And what will consumers do if manufacturers suddenly stop supplying parts for the EVs they already bought? In this video, we are going to run through 17 brands that are backing away from EVs and uncover the real truth driving this massive retreat. 17 automakers.
Electric cars, by the way. Now, the thing is, it's just a better car.
Would you buy a petrol car if electric cars were invented first? Leave your thoughts in the comments below. According to Cox Automotive, electric vehicles made up only 5.8% of new vehicle sales in the U.S. during the first quarter of 2026, down sharply from a peak of 10.6% in the third quarter of 2025. Total new EV sales in the U.S. also dropped around 27% year over year, falling from 296,622 units to 216,462 units. Specifically, Acura ZD sales plummeted by 98.5%, while Ford e-Ion crashed by nearly 69.6% over the same period. The issue is no longer whether electric cars can drive. The issue is whether they are convincing enough to replace gas cars in everyday life. Lamborghini, known as a global symbol of speed, status, and luxury, Lamborghini originally caught the market's attention when it unveiled plans to make the Lanzador its first ever electric vehicle in 2023. But just about a year later, CEO Stefan Winkelmann admitted that the high-performance supercar segment is not yet ready for full electric power. This reflects a glaring truth. If EVs were truly attractive to ultra-wealthy buyers, Lamborghini would not easily delay them. More importantly, Lamborghini is not abandoning electrification entirely. They are simply choosing a less risky path: plug-in hybrids. Lamborghini's official website states that the Direzione Core Tauri program kicked off its hybridization phase in 2023, with the Revuelto later expanding to the Urus SE and the Huracan successor in 2024. In other words, Lamborghini is still utilizing electricity, but they are not letting electricity completely replace the internal combustion engine. Therefore, Lamborghini shifting from pure EVs to plug-in hybrids is not a lack of progress. It is a realistic response to a market that lacks sufficient demand. Bentley pushed back its rollout schedule from 2025 to 2026 and has now further delayed its all-electric target out to 2035. This is no longer a standard minor technical adjustment. This is a sign that Bentley sees a very clear issue within the ultra-luxury demographic. Reuters reported that Bentley will debut its first EV as a luxury urban SUV in 2026, but will simultaneously continue selling plug-in hybrids until 2035. This directly contradicts its original goal of becoming a fully electric brand by 2030. Aston Martin is also part of this retreat. Initially, the company planned to launch its first EV in 2025. However, Reuters reported that Aston Martin pushed this timeline back to 2026 due to weaker than expected EV demand in the luxury segment. Later on, the plan was extended even further. Executive Chairman Lawrence Stroll openly stated that the initial excitement surrounding EVs was driven more by politics than actual consumer demand. Car and Driver also cited his assessment that while Aston Martin was technically ready to launch an EV in late 2025, the market contained far more hype than genuine demand. Porsche is a prime example of a brand suffering from the EV fever. According to Porsche's Q3 2025 financial report, its operating profit for the first 9 months of the year collapsed to just 40 million euros, a near total wipeout from the 4.035 billion euros recorded during the same period the previous year. Its operating profit margin plummeted from 14.1% down to a razor-thin 0.2%. This is a massive psychological shock for a brand that was once considered the money-printing machine of the sports car industry. The Taycan has also lost its initial magic. In the first 9 months of 2025, Porsche delivered 16,339 Taycans, marking a 22% drop year-over-year, primarily driven by a slowdown in global EV adoption rates. Mercedes-Benz. Mercedes-Benz also once set an ambitious target for electric and plug-in hybrid vehicles to account for 50% of its total sales by 2025. However, the automaker later pushed this milestone back to the end of the decade around 2030 because the market's transition pace was far slower than anticipated. As a result, the company will continue to keep the internal combustion engine alive well into the 2030s. Crucially, their high-performance lineups will still rely on gasoline engines and hybrids to prevent loyal customers from walking away. BMW. The BMW iX was once highly regarded as the brand's flagship electric SUV in the United States. But by 2026, the narrative flipped completely. Car and Driver reported that BMW confirmed the iX will be discontinued in the U.S. market after the 2026 model year, even though the vehicle may continue to live on in other global markets. Sales metrics expose the underlying problem perfectly. Motor One noted that iX sales peaked in the U.S. in 2023 at 17,301 units, slipped to 15,383 units in 2024, and dropped further to 12,587 units in 2025. During the first 3 months of 2026, sales plummeted by an additional 50.7%, moving a dismal 1,788 vehicles. 11. Volkswagen, standing right behind big names like Porsche and Mercedes-Benz. Volkswagen is suffering an identical fate. The brand once viewed the ID3 and i4 as the ultimate icons of a new era. In 2023, the Volkswagen brand alone delivered around 394,000 all-electric vehicles, marking a 21% increase year-over-year, according to its official statements. Yet immediately following that initial growth phase, intense cost pressures and shifting market demand exposed deep cracks in the blueprint. Volkswagen reached an agreement to slash over 35,000 jobs in Germany by 2030, while simultaneously cutting production capacity by roughly 734,000 vehicles across its domestic plants. Most notable is the transparent factory in Dresden, which used to build the ID3. Electrev reported that Volkswagen will completely terminate vehicle assembly at this location and repurpose the facility into an innovation center. Volvo. In September 2024, Volvo backed away from its pledge to sell 100% fully electric vehicles by 2030. Instead, management shifted the target to 90 to 100% electrified vehicles, a definition adjusted to include both pure EVs and plug-in hybrids. Alfa Romeo. The next generation of the Giulia and Stelvio was originally intended to be electric only. However, Autocar reports that these successors have been delayed for a redesign to include hybrid options rather than being purely electric. Even more significant is the return of the gasoline-powered Quadrifoglio versions, even though Alfa Romeo had previously prepared to close that chapter. The reason is simple. If the brand goes all electric too early, it risks alienating its most loyal fans. For Alfa, keeping gasoline and hybrid engines alive isn't a technical setback, it's an admission that their customers aren't ready to say goodbye to the internal combustion engine. Hyundai and Kia. These two brands were seen as the most successful in the EV wave outside of Tesla. The Hyundai Ioniq 5 and Kia EV6 launched in 2021, won numerous awards, and built a powerhouse tech image for the Korean duo. However, in the US, their electric catalog is beginning to shrink. According to S&P Global Mobility, Hyundai has enough 2025 Kona electric inventory that it will skip the 2026 model year in the US, as the vehicle no longer provides clear regulatory compliance benefits. Meanwhile, Car and Driver noted that Kia has officially discontinued the Niro EV in the US after the 2025 model year, though hybrid and plug-in hybrid variants will continue. Honda. In March 2026, Honda confirmed it had canceled the development and market launch of 3 EV models planned for North American production. Honda stated this was due to a strategic reassessment caused by a changing business environment, with Wards Auto reporting that related losses could reach a staggering 2.5 trillion yen over time. The Afeela project with Sony has also lost its momentum. Reuters reported that Sony Honda Mobility has officially canceled the development of the Afeela One and will issue full refunds to reservation holders. Ultimately, Honda is retreating to safer ground practical hybrids, particularly the CR-V hybrid. Mazda was never the fastest brand to rush into EVs, and perhaps that is precisely their advantage. The MX-30 highlighted very clear limitations: a short driving range, weak market appeal, and a tough time competing in the U.S. Cars Direct. Citing Automotive News, reported that Mazda has delayed its core EV plans to 2029 while dialing back EV investments to focus more heavily on hybrids. This is a fitting choice for Mazda. Their customers still want compact, fuel-efficient, easy-to-maintain gasoline vehicles that deliver a great driving feel. The CX-50, CX-5, and CX-90 prove that a massive market still exists for practical cars. Mazda doesn't win through marketing slogans. They win by understanding their buyers. Subaru Carsalos reported that Subaru has delayed plans for its first independently developed battery electric vehicle, BEV. This strategic pause comes amid slowing EV demand and sharply rising U.S. tariff pressures. This is a highly logical decision for Subaru. Their core customer base generally relies on the Forester Outback or Crosstrek to navigate snow-climb mountains, carry families, and tackle long-distance road trips. They need a dependable AWD system far more than an EV that forces them to map out charging stations in the dead of winter. Consequently, Subaru is shifting its gaze back to gasoline and hybrid setups. The Solterra may have served as a baseline experiment, but it cannot replace the formula that has sustained Subaru for decades. Mitsubishi entered the space incredibly early with the i-MiEV, one of the first mass-produced urban electric cars. However, that first-mover advantage did not translate into market leadership. In the US, Mitsubishi's next EV is not a completely house-engineered product. The Verge noted that the EV expected to launch in North America for 2026 will actually be built on the platform of the next-generation Nissan Leaf. To put it bluntly, Mitsubishi is playing it safe. The brand refuses to sink capital into building a proprietary EV architecture while the market remains volatile. They are leveraging their alliance with Nissan while continuing to survive on the Outlander Sport and their highly successful plug-in hybrid variants. Ford once boasted over 200,000 reservations for the F-150 Lightning. On paper, it looked like a revolution. But in the real world, trucks are tools, not just acceleration showpieces. Reuters noted that Ford previously had to halt F-150 Lightning production for 6 weeks to balance inventory and profitability, while its EV division projected a massive $5 billion loss for 2024. By 2026, AP News reported that Ford is entirely ending production of the all-electric F-150 Lightning. The brand is shifting its focus to an extended-range electric vehicle, REV variant backed by a gasoline engine generator, while retooling its Tennessee plant to build gas-powered trucks instead. Business Insider also tracked a staggering $4.8 billion loss in Ford's EV division for 2025, prompting CEO Jim Farley to state bluntly, "The customers have spoken." For Ford, the hard lesson was that an expensive electric pickup simply isn't ready to replace the gas-powered F-150. General Motors GM stands as the most expensive cautionary tale on this list. The automaker aggressively forced Cadillac and Buick down an all-electric roadmap, demanding that dealers invest heavily in charging stations, specialized tools, and EV retail infrastructure. But when real consumer demand failed to align with corporate projections, GM paid the price in cold hard cash. Ward's Auto reported that GM recorded roughly $6 billion in EV-related special charges for the fourth quarter of 2025. This included $1.8 billion in non-cash asset impairments and a staggering $4.2 billion cash hit. GM did not stumble due to a lack of funding. They stumbled because they misjudged the adoption pace of everyday car buyers. The root cause when the oxygen tank is pulled. The entire crisis comes down to a very simple reality. Electric vehicles in the US relied on government subsidies for far too long. For years, a $7,500 federal tax credit made EVs look artificially affordable. Reuters confirmed that this incentive officially expired on September 30th, 2025, eliminating both the $7,500 credit for new EVs and the $4,000 credit for used EVs. The market response was immediate and harsh. According to Cox Automotive, new EV sales in the U.S. during Q4 2025 plummeted by 46% compared to the previous quarter. Moving into Q1 2026, sales dropped another 27% year-over-year, crashing EV market share down to a meager 5.8%, a steep fall from its 10.6% peak in Q3 2025. This data leaves no room for excuses. If EVs were truly a superior product, buyers wouldn't have abandoned them the second the government handouts stopped. Instead, when forced to foot the entire bill themselves, consumers ran the numbers with cold logic. High initial prices, expensive insurance, inconvenient public charging, severe winter range loss, and catastrophic depreciation. Meanwhile, hybrids are winning because they don't force buyers to change their daily habits. You still fill up with gas in minutes, drive long distances without anxiety, and get excellent fuel economy without installing a home charger. Toyota has emerged as the massive winner here. An official report from Toyota Motor North America revealed that in 2025, the automaker sold 1,183,248 electrified vehicles in the U.S., a 17.6% jump that made up 47% of its total volume. Cox Automotive also noted that hybrid vehicle sales surged 57% year-over-year, with Toyota commanding a dominant 43% share of the total U.S. hybrid market. Car buyers are not fighting new technology. They are simply refusing to pay a premium for a solution that isn't as practical as the gas and hybrid vehicles they already rely on. 4. Conclusion. Ultimately, the retreat of these 17 automakers proves one clear truth: the market cannot be forced to move faster than real-world consumer demand. Buyers don't hate technology. They just don't want to overpay for a product that costs more, depreciates faster, takes too long to charge, and isn't ready for daily life. Do you have your answer yet to the question? Would you buy a petrol car if electric cars were invented first? If you have a take on that, share your thoughts in the comments below. And if you want to stay on top of the latest automotive insights, don't forget to drop a like and subscribe so you never miss our next breakdown.